Hey guys, my name is Ruben Dante, and today we're going to go over options. And I did a video on how to set up the options mosaic layout on interactive brokers, and that seems to be pretty popular. And I've gotten a lot of questions lately asking me about options in general and how to trade them. So we're going to go over some basic option strategies. Nothing I say is a buy, sell, or hold recommendation. Everything is just for educational purposes. Trading options is a highly leveraged asset class in which you can lose all or more of your account. Make sure to read the risk disclosures associated with trading options, and keep in mind that you are supposed to be somewhat of a already active trader for most platforms to allow you to trade options. So like I said, keep that in mind. I have been trading for a while. I was a student at a trading academy where I now work. So they're okay with me generally making these videos. If ever they're not, I love my job, so they will come down. So don't expect these to be out here forever, and just keep that in mind. I love my work, so if at any time they become a conflict, they will come down. So meanwhile, though, enjoy them. As of now, all of the videos that I'm making are only for my subscribers. They're going to be unlisted. I just think it's better that way to keep kind of like a community going on. If you have any questions, contact me on Twitter. So anyway, when you go over options, you generally have four option possibilities. You can buy a call, you can sell a call, you can buy a put, you can sell a put, and then you can do a lot of other strategies with that. Iron condors, etc. So right now we're just going to go over the basics, and we're going to go over the deltas and kind of what they mean. So options at first can seem daunting compared to futures or forex or even stock trading. There are benefits of trading options, mostly leverage. I guess let's just get right into it. So this is my options layout, and like I said, there's a video on that, on how and why I made it like this. So when you buy a call, which is what I've seen to be the most popular option strategy, you're essentially bullish on the stock, and you are doing debit trade, which essentially means you're paying to buy the option. So like, let's take right now I have Tesla open. So like, let's take this for example. Tesla seems to be trading right now at 130 or so, or I'm sorry, 250. I don't know where I got that from. 250 based on this chart that I have up here. So when you're buying a call, most people that I see buy calls usually buy it an in the money call, which essentially means that's intrinsic value. So if right now it's at 250 and we buy the 245 call, and it's $12.65. Oh shoot, let me unlink this. Tesla. Okay, so we said the 245 has a roughly $5 of intrinsic value because it's Tesla's trading right now at 240, or I'm sorry, 250. And the strike for this one is 245. So $5 of that is already in the money. So it would cost you $12.10 if you buy it at the bid, to which we would use this. So the $12.10 minus the intrinsic value that it has is roughly $7.10, because it's trading at 150. You're $5 in the money. It's 12. So essentially, you're paying the difference to buy the call. And most people, when you buy the call, you're essentially looking at the delta and the expiration. So for every dollar that it moves up from the current price, you would get paid the delta decimal. So for every dollar that it moves up, you would get essentially paid 65 cents. Which is the delta for this. And usually when you're buying a call, you are giving yourself more room to be right. So you would probably buy it further out in expiration. So June, June should be sufficient enough. Let me just say that. So that essentially, when you buy a call, you have pretty limited risk. The risk you have is essentially what you paid for the premium. You can also buy a put. And when you buy a put, you are bearish on the stock. So essentially, you're buying a put. You have a negative delta. So you are making $1 for, or I'm sorry. So if you're buying the 245 put, you're basically making 39 cents for every dollar that it goes down. And then you have the sell. So when you sell, when you buy a put, your risk is also fairly limited. You can only risk what you paid for the premium, what you paid to buy the put, and your risk or your reward is fairly larger. When you sell a put, you would usually sell it to collect a premium. So you would usually sell a put below where you think price is going to go, way below. So when you're selling a put, you're there's different ways why people do that. So if Tesla is trading at 250, when you're selling a put, you're collecting a premium. So the way that I usually see most people sell a put is where they want to buy a stock. So like, let's say Tesla's trading right now at 250 and I am willing to buy Tesla at 225. So rather than waiting for price to come down to where I want to buy it, let's say 229, instead of waiting for that price to come down to me, I can sell the put and collect the premium. Meanwhile, price comes to that. So, when you sell a put, your risk is fairly large. For example, let's go here to 229. So let's say that I want to buy Tesla at 229 if price ever came to that. So then I might want to sell a put at let's see here, something below 229. So I guess I could do 230. So then I would sell I'm sorry. For that, I would use this, which is called Strategy Builder, and you can see that on the first video on how to set this grid up. So we're looking for 229 to 230. So I want to sell it. So essentially, I am collecting 239. And my risk is $3,045. So as you can see, it's a fairly large risk, which is more or less if the stock went to zero. Again, essentially for a lot of people, they think of it as free money because they're saying, well, I want to buy Tesla at 230 anyway, rather than wait for it and put a limit order. I'll sell a put and I'll get paid on the time while Tesla gets there, if it ever does. And if it doesn't, it expires worthless. You keep the premium and life goes on. So it's a pretty aggressive, I guess, strategy, but it makes sense for a lot of people because, you know, they want to get paid on time. And in a lot of ways, that's what options is all about. So, and I'm going to go over at the end of the video how you can offset that. So essentially, that's when you sell a put. It would usually be way below current price and below where you even think you want to buy it at. When you sell a call, you are usually selling a call above current price, and you are getting paid $1. Excuse me. You're getting paid. So when you're selling the call, you're selling it above current price, and you're getting paid for every dollar that goes down. You would get paid the negative delta off of that. So if you are selling the, let's see here, the two, what are we at? 250. So if you're selling, let's see. And these are just for example, guys. I'm not really analyzing these trades. I'm just trying to set an example as to when you would use something like this. Oh, you know what? That's why. Let me lock this layout. Great. So let's see. So let's say 272. So I'm looking to sell a call above where I would short it usually. So let's see, 272. So I guess it'd be 275 and call. I would sell. Darn it. I would do it from here. And the video explains as to why I have this down here. But so 275, we are selling. So it's a short call. So essentially, you're making $19 for a dollar that goes down when you're selling the call. And the risk to sell a call is kind of unlimited, because the stock could go to heaven, I guess. And so then you have the obligation to sell it at that price. So you'd have the obligation to sell it at 275 if you were exercised and the stock went to 500. Or excuse me, you do have the obligation to sell it at 275 even if the stock goes to, let's say, 1,000. So that's relatively, as you can see, you get paid on something that's probably not going to happen, but you run that risk. And so we went over, and then when you buy a put, essentially also you are bearish, and you are usually buying the put above current price. And so let's see. So what's easy and what's cool about interactive brokers is that you can kind of say, so we're already above current price, right? Let's say I want to go the other way. So you can, buy put, and and you're essentially making $1 per delta. For the delta, let's see, and the delta should be listed on here. Let me see. Configure columns. So I'm gonna add the delta. Oh, it's already on there. Okay, so for every dollar that goes out, it'd be 81 cents when you're buying the put above current price, is usually when people would do it. So again, when you buy a put, you're usually betting the stock will go down, and you are fairly at a place where you already want to short it anyway. The risk is pretty limited because the most you can lose is the premium. And that's usually not, I mean, it'll cost you a premium, but you don't have this vast risk, right? And the reward is pretty unlimited because, I mean, your reward is fairly large because the stock could theoretically go to zero. So it's not quite unlimited, but it's a bit, it's a good amount. So that's generally how most people would use the calls and the puts. You would buy a call when you're bullish and you're making the delta for every dollar that goes up. So if the delta is 0.6, then for every dollar that the stock goes up, you're making 60 cents. And then that can change. And I don't think I have enough time to go over that in this video, but the delta could change. And then you would sell a call usually above current price when you think a stock is going to go down, and the delta would be negative, and for every dollar that the stock would go down, you would make the negative delta. As if the negative is, delta negative 0.30, then it's 30 cents for a dollar that goes down. You would sell a put usually below current price, where you already want to buy this stock, as it could free fall, and then you could lose a good amount. So a lot of times you see people sell a put below where they want to buy a stock, so that way they make money on time. And you would buy the put, you would buy the put above where you would want to short it usually, and then you would so essentially you're bearish, and you would make the delta per dollar that goes down, typically. Vega is volatility, so how volatility will impact your option contract, and then theta is time. Rho is interest rates, and then gamma is the rate in which the delta is moving or affected. So that one's kind of tricky to understand. So it's the rate of change of the delta, and I might do a video on that. I don't think it's super relevant to do that, but I might. So just really quick, I guess I'm going to go over some ways you could still benefit from selling a put and kind of protect yourself. So like I said earlier, selling a put theoretically is very, you could lose a lot for a small premium you may collect. But what a lot of people may do is that, let's say that I do want to buy, like we said, Tesla at 230, theoretically. What we can do is sell that 230, let's see, that 230 put, and then cover by buying that 225 put, in which would be called a bull put. Okay. So we would sell the 230 put, and we would buy the 225 put. So this would be considered a bull put by Interactive Works, and it'll name it right here. So essentially, we're collecting a premium off of the 230, which is where we want to buy it anyway. But in a worst case scenario, we will be covered at 225. So if it goes to zero, the most that we can lose is $500, because 30 by 25 is $5 times 100 shares. We're only exposed $500, but it's very unlikely that that would even happen in the first place. It would be a credit, and we'd be receiving a credit of it looks here 61 cents. So let's see, performance. So it is 85%. So here's the table. I might do a video on this as well if you guys really want me to. So it says profit probability 85%. Max return is $60. The max loss is $440. So again, the risk to reward ratio is very low. It's opposite, actually. But essentially, if we're doing something like this, we're 99% sure something like this is not going to happen. A. And B, if it does happen, it's something that we wanted to do anyway. We wanted to buy Tesla at 230 to begin with. So that's usually the way you would cover yourself if you really wanted to do something like that. And that's called a bull put spread. So that's about all the things I can go over right now. Let me know if you guys have any questions. You can pretty much, in my opinion, kind of play with the spreads just by the example I gave you of the bull put spread, and kind of once you understand how the different calls work, you can kind of start to malleably play with the different strategies as you see fit. Usually, if you are doing a credit trade, which means you're receiving a premium, a lot of times I see people usually doing less days, maybe like 45 to 60 days. When you're doing a debit, a lot of times people will give themselves more time to be right, as you know, the risk is only limited to the premium. So that's something to consider. That's all I can think of for now. If you guys have any questions, comments, concerns, let me know. Like I said, these videos are now, from moving forward, we're going to be private only, not private, but unlisted, so that I can have more of a I guess a community, a trading community in my channel, for as long as that I can have this, as long as it's not a conflict. So anyway, guys, I hope you guys found this helpful and educational. I know I just uploaded another options video, but I think this one is more beneficial. I will do one in Spanish. So anyways, if you have any questions, tweet me. I don't really check my YouTube all that much. And thank you for watching. Subscribe if you find this informative, and if you want to see anything further, subscribe, because it will be unlisted moving forward. So thank you so much, guys, and have a great rest of your day.